Today I'm going to be talking about Chapter 9 in Fragile by Design. It's the chapter called Durable Partners, and it's about politics and banking in Canada. The authors go into an overview of the Canadian banking system, talking about certain traits that make it unique, um, certain ways in which the Canadian banking system developed, how it was a product of its colonial history, and the authors go on to compare and contrast the Canadian banking system with the banking system in the United States. Now, the central thesis of this chapter, it kind of rides on the fact that the Canadian banking system is extremely stable, and in fact, if you look at just like rankings of done by different types of reporting agencies, such as like the World Economic Forum, they've actually ranked the Canadian banking system as the soundest banking system in the world for the past 6 years. So, Chapter 9 is a nice introduction to what makes it tick. If you look underneath the hood, we can start to sort of dissect what's going on in the Canadian banking system and tease out a few explanations for why the Canadian banking system is so stable, how the structure of the Canadian banking system interplays with the regulation and the legislative bodies that are overseeing the success and minimizing the risks that are incurred and they're inherent in any banking system. So first we can talk about stability. And in this presentation, just because I am recording this on a video camera, it's not going to be so easy to flip back and forth between the presentation itself and my overhead. I actually came up with a slide deck that roughly follows along this presentation. The slide deck is pretty sparse, so I think it can be viewed as needed. So it's a good general guide for what I'm going to be talking about today. Anyways, the Canadian banking system is extremely stable. Since 1840, the U.S. has had 12 major banking crises, while Canada has had none, not even during the Great Depression. And that stability is particularly surprising given that Canada is a staples-based economy, and it's heavily reliant on exports. So if it's obtaining all these natural resources and commodities in Canada, and especially in rural areas, through mining, agriculture, fishing, etc., and it's exporting these goods to other countries, then if there are issues in other countries, like let's say there's a dried up demand for a certain commodity, then the Canadian industry, the Canadian businesses in that staples-based economy are going to suffer. And so it turns out that those are actually those industries have volatile business cycles, and it's surprising that the Canadian banking system doesn't seem to follow that trend. We don't see that kind of volatility. It's even more surprising because for much of Canadian history, there was actually no central bank and not a lot of government intervention. In fact, Canada didn't found a central bank until 1935, and the reason that it did that was so farmers in the Canadian West, they demanded a more active monetary policy to counteract rising prices, inflation, and so they needed a more active monetary policy. And so at that point, a central bank was found, and started regulating fiscal policy a little bit more actively. So the question is, in spite of all of these reasons why the banking system might be volatile, we have to ask, why is the Canadian banking system so stable? What makes it so stable? And there are a few different factors that I think are pertinent to considering. And I actually already mentioned two in which that the authors take a lot of time to flesh out, and that would be the structure of the Canadian banking system, as well as regulation of the Canadian banking system. So forgive me for a second, I'm just charging in this computer so I don't run out of battery during this presentation. Sorry about that. So we can start with looking at the structure of the Canadian banking system. And we see that it's an oligopoly. It has a very small number of large banks with nationwide branches. And in fact, the Canadian banking system is commonly referred to as just the Big Five because there are five major banks: RBC, TD, Scotiabank, BMO, and CIBC. And they control about 90% of banking assets throughout Canada. And so, you're looking at just a very small number of banks that are controlling a huge country in terms of landmass, smaller on the population side, for sure. And it's a wealthy country. So, there's a lot of demand for credit. There's a lot of enterprise going on because of so many natural resources. So banking is an extremely important facet to the economic growth and development of Canada throughout its colonial history. We even see that it became more of a centralized system as we go on through the 20th century, because you see a lot of mergers and acquisitions between banks, and so smaller banks merge into larger banks, and now it's boiled down to the Big Five, those ones that I mentioned. The advantage of having an oligopoly in the context of stability is that you get a lot of diversification of loan portfolios. Like, imagine you have one bank, and that bank is servicing many different industries throughout Canada. So if you're servicing a region that has a lot of mining businesses, and you're also at the same time serving an area that has a lot of, let's say, timber businesses, then let's say if the mining businesses dry up and they start to default on the business loans that they took out, then that bank can offset some of those losses if there's growth, like tremendous growth in the timber industry, and there's an increase in the demand for credit. So that sort of allows banks to have pretty diversified loans across the board and across many different industries, because again, you just have these Big Five banks servicing most of Canada. Another advantage is that if you do have a scenario where you have a branch bank way out in a rural area that starts to, people start to lose faith in the bank, and they start to make bank runs and withdraw their deposits. Various reasons, economic reasons why that might be happening. Declining jobs and failing industries, layoffs, etc. That bank can cover that one distant branch by easily transferring funds over to it, and to ensure that that branch doesn't completely dissolve. It can kind of prop it up a bit. But of course, on the flip side, there are disadvantages to having oligopoly, and I think the primary one is the monopoly effect, where you don't have that much price competition because you have these five big banks that can almost collaborate and raise prices. Would be fairly illegal, and I'm sure regulations in Canada do prevent that from happening. But it's certainly something to consider, and it's definitely it could be problematic. It has the potential to be problematic. So, of course, that's where the regulation has to step in and prevent these Big Five banks from reaping huge profits at the expense of the consumer, who has to pay enormous amounts of money to borrow money and to finance their business ventures or home ownership, whatever it may be. So that's where the regulation has to step in and ensure in a quality way that Canadian banks aren't just totally ripping off the public at large. So it turns out that the regulations in Canada for banking is actually really it's got a solid system in place. Um, you have it's a popularly elected legislative body that oversees the central government in Canada. Particularly, you have the elected lower house, and they play the largest role in regulating the financial industry in Canada. And they limit the extent to which banks can earn these monopoly profits. And one of the ways that they do that is through frequent legislative reviews and rechartering of banks. It was the case for every 10 years until 1992. Banks had to be rechartered, and there was huge legislative overhauls. And then after 1992, it became every 5 years that this legislative body did those kind of reviews. There's the dictum that's quoted in the textbook in Fragile by Design: pigs get fat, hogs get slaughtered. And I found that to be interesting because you basically have the right amount of legislation and oversight in place to ensure that rampant greed doesn't subsume the Canadian banking system. And it's just extremely important to strike a fine balance between letting these banks be really big, but also regulating them at the same time to ensure that the consumers are protected and that borrowers have access to credit that they need for their own ventures. So and that's something in the United States that I think that needs a lot of work, and I hope to shed a little bit more light on that as we go further into the presentation. So, how did the Canadian banking system get to this point? Well, of course, it's a product of colonial history, and for what I'm going to talk about today, I'm going to provide a very brief overview of some landmark moments that kind of made that, develop the Canadian banking system into the state that it is today. And I don't mean to be hand-wavy or anything like that. I just think that there are a couple more interesting things in this chapter to focus on, particularly what makes how we can tell it's a stable banking system. So I'm not going to dwell too long on the colonial history. But it is definitely worth mentioning that much of the colonial history is characterized by Great Britain's determination to hold on to Canada as a colony. And it was only over time that Britain gave the central government a monopoly over economic policy making, and it sort of ceded control to a central government in Canada. And it did so very strategically to ensure that central government was overly represented by individuals of British origin. Because basically, you have a huge French population in Canada as well. And so in the colonial history, there's a lot of, in a way, battling between the French and the British in consolidating power and really, I guess, getting the reins to the government and to the entire country as a whole. So I will touch on that, and it really happened because of the British North America Act of 1867. It was that act that actually led Canada to become it effectively made Canada a sovereign nation. And what it did was it divided Canadian land into 7 provinces, only one of which was a French-dominated region, French-dominated province, Quebec. The rest of them were all actually composed mostly of people of British origin. So, of course, those provincial governments are going to be oversaw by the central government of Canada, and the central government is going to be represented by those in the provinces. So having 7 provinces, and 6 of the 7 having so much British influence, you're going to get a lot of British influence at the central government level. And so any of the powers that were not explicitly delegated to the provinces was left to the national government, and that included the power to regulate the banks. So the national government actually promoted these nationwide branch banks and across all regions of Canada. And the reason why was because you had a lot of entrepreneurs way out in the rural areas of Canada that sought to, and they were merchants that sought to move raw materials from those places over through uninhabited land to Great Britain, to Europe. And so that those merchants formed a big lobbying power for banking politics, especially throughout the 20th century. And that led the central government, to really support that micro aspect of the economy. It's actually not micro at all. It was a very sizable portion of the Canadian economy. And so that merchant lobby, especially that of British origin, who comprised those merchants that were out there in rural Canada, they were the ones that really started to push the national government to have their interests kept in mind. And so that sort of went hand in hand with the creation of this oligopoly branch banking system. So not only, is Canada, it's, sort of has a centralized banking system, centralized power given to that legislative body, it was also very protective of Canadian banks, and it actually staved off the influence of foreign banks, which other colonial countries definitely did not have the luxury of. So even in 2011, we look at 2011, 7.1% of banking assets in Canada were owned by foreign banks. And the way that, Canada has kept this is through its regulations. So Canada has three classes of banks. You have the Schedule I banks, which are domestically owned banks chartered in Canada, and they can't be owned by a foreign bank because they're required to be widely held. So again, you have ties to the central government of Canada, and that's a long historical relationship. Schedule II banks are foreign-owned banks that are chartered in Canada, and they have restrictions on their growth because they have to overcome a lot of hurdles to obtain a charter. Then there are constraints placed on their ability to grow via discretionary regulation of their capital ratio requirements, their liquidity ratio, and then even restrictions on the kinds of assets that they are permitted to hold. So they're limited from being able to compete with that big five, with the central banks of Canada. Then the Schedule III banks, their branches owned by foreign banks, and they're operating in Canada without a Canadian charter. Without a charter, there's less trust. You're not going to have a whole lot of growth there. So the question emerges, if Canada is so stable and it's been such a robust banking system, inoculated from outside risk and volatility, is it trading off that stability for efficiency, or for something else for that matter? So imagine you have a bank who pays nothing for deposit and only lends out to individuals with AAA credit who personally know the bank director. That bank would be highly stable as it takes on little credit risk, but that would be at the expense of economic growth and lower rates of social mobility. So you have talented entrepreneurs, small businesses, households that would be starved for credit because they don't personally know the bank director, and maybe they don't have, AAA credit. They're not going to be able to get an account with this bank, and they're not going to be able to get any sort of financing from them. So that would be a really stable bank, undoubtedly, because there's so much risk management involved. There's so much control over the loans and that the bank gives out, and they're only making safe bets. So the question is that what Canada is doing? And the authors jump into uh, a few metrics to kind of discuss what's going on here. And it turns out the answer is resoundingly no. Canada is not sacrificing its economic growth for stability and safety. In fact, the authors they basically at this point in the chapter they start to discuss they start to compare and contrast the U.S. banking system with the banking system in Canada. And what we see here is that first they look at the price of credit. And they ask the question, has it been historically higher or lower in Canada? It turns out that looking at all these several studies in the 20th century, that on average, interest rates charged on loans were about the same for both countries, so the price of credit is about the same. However, the interest rates paid on deposits in Canada were higher. So Canada was paying the people that were going depositing their money into their banks a little bit more money. And so the interest rate spread in Canada was smaller. And that's the differential between the average interest rates on a loan and the average, rates paid on deposits. So that kind of narrows the band of price competition in Canada compared to the United States. And it actually turns out from these studies, they've shown that Canada has even had less regional variability in its pricing. So, urban areas and rural areas are going to have roughly comparable prices for credit. So, I mean, now you might start to think, well, then Canadian banks might not be as profitable because the interest rate spreads are low. But here's where it gets interesting, is that the authors then look at the capital to asset ratio. And they see that in 1920, Canadian banks maintained a ratio of 8.6% versus 11.5% in the United States. Then in that same year, Canada lent out 72.7% of their assets compared to only 53.1% in the US. The authors claim that these differences are reflective of the century as a whole. So here we see that in some ways, Canada's not being very stingy and just not giving out loans. It seems that they're actually doing a lot of lending, 72.7% of their assets compared to 53.1% in the United States. So that is definitely interesting. In my mind, I'm starting to think maybe, if they have a stable system and they're lending more than the United States, perhaps they have really good checks and balances for who they're agreeing to loan out to, and their credit rating systems must be really impeccable. Must be a lot of trust in the financial reporting of these companies, and collecting the necessary documentation to verify income and verify credit, obviously verify employment history in terms of if it's an individual getting a loan. So it just seems to me there's a lot of nice checks in place in Canada that actually really bolster the stability of the system. The authors also look at the ratio of commercial bank private credit to GDP, and this is actually a graph that's in the overhead. So if you want to take a look at that graph, it's also in the book as well. I took a screenshot of this graph, and what I found interesting was about the 1980 mark, Canada really starts to outstrip the United States in terms of the ratio of commercial bank private credit to GDP. And in general, Canadian credit, to GDP, that ratio is roughly equal or greater than the U.S. over time. And it's interesting because that outstripping moment after 1980 is actually correlated with an increase in the concentration of the Canadian banking system. As I talked about earlier, the mergers led to less and less banks controlling the whole market, so you have the big five. And what the authors sort of suggest, and what really intrigues me about the Canadian banking system, I'd say overall, is this idea that one of the explanations for how the ratio of commercial bank private credit to GDP, one of the reasons why that number might have skyrocketed in Canada is because regulations in Canada basically allow these big five banks to absorb a lot of these fringe banking activities, shadow banking, other types of financial services offered by different financial institutions, stuff like what you would see in the United States to be handled by credit unions, insurance companies, mutual funds, pension funds, investment banks, hedge funds. Of course, you have those same kinds of firms in Canada, but to me, I'm starting to think that a lot of that gets absorbed by private commercial banks. And from a legislative standpoint, it makes it a little easier to regulate because you're creating regulations for five big players. In the U.S., there might be much more complexity to the issue because now all of a sudden you're regulating all of these shadow financial firms that are not registered with the SEC and are cropping up here and there, and there might be Ponzi schemes popping up and pump and dump schemes, and all of these kind of illicit activity can easily develop, and you have regulations in place to prevent that, but you have all these pockets in the U.S. that kind of permit that to happen because it's not being absorbed by a larger body. It's not being absorbed by this big bank, and and the legislators are going to be less confused when they're dealing with one bank versus this, I suppose, possibly nefarious and amorphous, nebulous kind of industry. And that I would like to put a pin into because in my next presentation, I'm going to be talking about those kinds of fringe industries that are a product of technological advancement and innovation in the financial industry in terms of new securities, new instruments being put onto the market and traded. So returning back to Canada and looking at metrics for Canada's stability. Another thing to think about is its distribution of credit across rural areas. And as I've already alluded to, Canada has done a great job of this kind of diversification and branching out to many different types of regional areas, including very remote places. We basically see in 1912 one bank for 2,847 inhabitants in Canada compared to one for every 3,407 in a more densely populated United States. Now by 1940, these differences grow enormously. It's only 28 years later, you have one bank per every 3,410 in Canada versus one bank per 7,325 inhabitants in the United States. So this really speaks to the strength of the branching system in Canada because you can have a big bank that can consolidate its costs, like all of its administrative costs, in a single back office so that the marginal cost of opening up a new bank way out in the middle of nowhere, Nova Scotia, wherever, is significantly lower than if you had a new bank, regional bank that crops up there. And that bank might have to take out loans from a bank to start its own banking service, and it just becomes a more difficult problem. And there's a level of efficiency in operating with these big banks. Finally, this is also something that I've touched on a couple times here, is crediting Canada with its stellar risk management skills. The authors use a graph of essentially mortgages in arrears from, I think it's 1991 to like 2011, looking at that 20-year time gap. And of course, during the 2007 to 2009 banking crisis, you see a skyrocket in the amount of overdue payments in the United States, and Canada just remains flat in the graph, at close to 1%, below 1%. So that's interesting, definitely, that Canada didn't succumb to the same kinds of problems, being asleep at the wheel, all the different parties that sort of dropped the ball in what led to the housing crisis. Canada just had a more robust system in place. So that is definitely, it speaks to Canada as having such a solid system as a whole. Certainly, in researching this project, I definitely grew to really admire this facet of Canada's banking system, and I think that the U.S. can learn a lot, because the U.S. does have big banks as well. We do have very, very big banks that we call too big to fail, and we definitely those banks and the directors and people high up in those banks have definitely come under a lot of scrutiny over the past few years because of the housing crisis. So it's interesting to see Canada have these big banks that are probably also too big to fail, but they don't have that kind of volatility. They're just a little sturdier than what we have here in the United States, and that is definitely a product of the differences in our regulatory bodies and the way that we oversee the financial industry from a legal standpoint. And I would like to get a little bit more into that line of inquiry, which I will sort of touch on to as well in my second presentation, which will be on the securitization of real estate, specifically the tokenization of real estate through the use of cryptocurrency. And basically, it's an invention of a new sort of financial instrument that can be bought and sold on a market, on an exchange. And I'll get into that in the next video. But for now, I'd like to wrap up a little bit on Canada by closing with the quote that was up at the beginning of the chapter. The authors open up with the quote from The Girl in the Cafe, and it goes, 3 hours next to the dullest man in Canada, and that's a pretty competitive category. So I haven't seen the movie. I'm a little out of context, perhaps, here, but from what I got from the quote, I can kind of see it as a playful jab at the Canadians. I think the authors are American, and so there's a little bit of that rivalry humor that you see in creating this caricature of Canada or Canadian people as being dull, boring, friendly, but predictable and stable. And it is a little amusing because it paints Canada to be a little bit simplistic. But if we look below the surface, we see that it's really not so simple. And it's, in some sense, not really that big of an accident that Canada has such a stable banking system. It just has a stellar structure with great regulatory oversight. And so the stability is really predicated on a whole lot of activity. Again, that structure is an oligopoly. You got the branching system. So you have a couple of big banks that are branched out all across Canada, even deep into the rural areas. And it provides an easy, steady supply of credit to all those areas. And it protects itself with the diversification of its loan portfolio as a result. Then, of course, on the regulatory side, you have those frequent legislative overhauls. Again, up until 1992 is every 10 years rechartering a bank's big legislative overhaul. After 1992, it's every 5 years. So that the frequency in which Canada is reviewing its laws enable it to really update the legal framework so that it's adopting more current language. And that will also allow it to allow the regulations to be paired alongside new innovation, new technology that changes the way that humans interact with one another. And that's especially in these past 20 years, the advent of the internet and internet-related technologies. We've really come to communicate and transact in different ways, and so it's very important for regulations to keep up with the times, per se. So, of course, another big thing I should mention too, in summary, is that the regulations in Canada do a good job of preventing the monopoly effect and protect borrowers from having these big five collaborate and raise the price of credit to make it unaffordable so that they can achieve sky-high profits. So you need that legislative oversight to prevent that greed. Pigs get fat, hogs get slaughtered. So Canada clearly has a very stable system, and that's underpinned by a durable relationship between the Canadian central government, that's the legislative bodies, the merchants, historically those that are really out in the Netherlands of Canada, conducting their own commerce, their own business enterprises, and them advocating for the central government to install a system that would be beneficial to them. And then the bankers actually, being regulated by the central government in a manner that prevents them from getting exorbitant profit, helps the industry of these merchants, and is stable and is trustworthy for other enterprises too, not just farmers and agricultural merchants, etc. For homeowners, people that want to go and buy a home, they can trust TD Bank or BMO. So ultimately, Canada, one of the best banking systems in the world, it turns out. That's something that I learned in reading this chapter and going through it. And at this point, if there's any questions, shoot me an email, leave it in the comments below. Thanks.